Good morning and welcome everyone to the Money Control live stream. You have tuned into a brand new episode of Markets with Santo and CJ. Well, I hope you guys had a great rest yesterday because we are in for major, market action over the next week. Investors will be catching up to the Tuesday's absence, but it seems Dalal Street is in for a green morning, Santo, and the SGX Nifty 50 futures are indicating that we could open higher by as much as 60 to 70 points. It's not much, but it's a good start, right? That said, the investors' attention today is likely to be divided by two major events that are happening. A, the big bang IPO of LIC, Life Insurance Corporation of India, is going live today. So investors will be able to subscribe to the issue from today, and we are going to be getting to know by how much the US Federal Reserve will raise interest rates later today. The outcome of the Fed meeting to two-day Fed meeting will be out later in the evening. So yeah, two major events to watch out for.
Well, trust you, CJ, to always focus on the positive and the brighter side of things, but there's also news that's not so great right now. India's trade deficit, that's widened to close to about $20 billion. And what's worrying is that, there was a sharp dip in exports as well, month on month. That's okay. While it has grown about 24% year on year, for the month it was down by close to 10%. And with crude prices staying where they are, right, this deficit is only likely to widen in the days ahead. Now it seems the crude seems to have almost comfortably settled above $100 a barrel, and this at a time when FIs are also bearish on India, so that has huge implications for the country's current account deficit.
Well, I think all that well and good, but I think the focus again is going to be the big bang IPO of LIC. And there is, the reason I say this is that, as much as there is always excitement when an IPO gets the tag of big IPO or a biggest ever IPO, there's also a reason for cautiousness within the market, because generally these sort of IPOs tend to come when, the mood of the market is very good, when there is, a good rally that has happened, and investors are very, companies feel that investors will be comfortable to, throw in as much money as they want to raise. But if you go by by past experiences, big IPOs tend to come during near to or probably during market tops, and probably that would be the question on everybody's mind. Will this IPO end up being that signal for market top for the Nifty 50 and the Sensex for the near term?
Well, CJ, I take your point. Now, in the past, this is something that you also said that what has held true in the past is no longer now the case. But you have seen cases where big IPOs have coincided with market tops, but there are a few differences here. Now, if you look at it, if you were to adjust for inflation, LIC's IPO of 21,000 crores is quite huge in absolute terms. But if you compare it with previous IPOs like Reliance Power or DLF for that matter, even Coal India, adjusting for inflation, this is still not that big an issue, right? This is relative. I'm speaking on a relative basis. Second point is valuations. If you see most of the IPOs which led to a market top, they were hyped. For instance, look at Reliance Power in 2008. Look at Paytm in 2021. Right? There was huge IPOs, and everyone was questioning the valuations. The valuations were atrocious in both cases. But look at LIC. You can't say that valuations are atrocious. If anything, it's been priced very sensibly at a very healthy discount to what the existing players are right now. Look at its market share. All put together, I think this one is very different. So this issue, right, if you're saying that it's overhyped, or there is hype because obviously it's the largest insurer with such a huge market share, but I would bet that this is not going to be a trigger for the market top.
I take your point, Santo. The valuation, the cut in valuations have definitely got a lot of investors salivating, and analysts have been coming out with recommendations to subscribe to the issue. But I will, since you have been throwing my past statements at my face, so it's time for me to just return the honor. And you tend to say that if a company is cheaply priced, it's probably because it deserves to, right? And probably LIC is the largest life insurance out there. It has a portfolio, equity portfolio, investment portfolio that is almost 4 times that of the entire mutual fund industry. But let's look at the fundamentals here. It may be the largest player, but it has been consistently losing market share over the past few years. There was a moment in 17-18 when it actually started gaining market share, but that momentum has also been lost. Secondly, if you look at the cost structure of LIC, LIC is still very largely dependent on field, foot on the ground, field agents who distributed its policies throughout the country, right, from the smallest of towns to the biggest of cities. But at the same time, its private rivals are utilizing the digital avenues to reach out to the same set of customers, and therefore they're doing it at a very lower cost. So the question mark now remains, A, whether the cut in valuation is also a reflection of possibly lower growth potential for LIC compared to the private sector peers, as well as whether LIC's cost structure will improve enough to enable it to probably be a bit more nimble and a bit more flexible institution.
Well, CJ, the bigger worry for the market, I mean, all those things to some extent are reflecting in the price. So, they are losing market share, and I take all that points, but to a large extent that's captured in the price. But I think the bigger worry for the market was, in the past, LIC was known for bailing out other state-owned organizations. Now, will that continue? So, typically there is always a discount attached to a PSU company. That is the bigger thing to be worried about.
We cannot rule out that it will not continue anymore. That said, we have a lot of stock specific action to catch up on. So let's dive into it, Santo.
Yes. So starting with Adani Wilmar, it's announced that it is taking over the rice brands of Kohinoor. Now, interestingly, it has not specified the size of the acquisition. So, a lot of hype over the Adani Wilmar stock ever since its IPO. It's been almost moving one way. It seems to be in a parallel universe of its own. None of the rules that apply to other stocks seem to be applying to it.
Right.
But the fourth quarter earnings were a big disappointment, both in terms of operating profit as well as net profit growth. However, Edelweiss has increased its earnings per estimate for FY24 for Adani Wilmar. It says that Adani Wilmar will continue to take market share from its smaller rivals, even though inflationary pressures are hurting Adani Wilmar at this point. It feels that that could hurt smaller players even more. So it has also increased price target for the stock to about 735 rupees.
I actually agree with Edelweiss on that, because true, raw material prices for Adani Wilmar have shot through the roof. What with the the Russia-Ukraine issue, with Indonesia ban on crude palm oil, but at the same time, the company's dominance in the edible oil market also ensures that it can steadily pass on those costs to the consumer. So therefore, probably volumes may not be that much of a concern for Adani Wilmar, because these are sticky volumes. These are consumers who have to cook food at home, right? You cannot not cook food. So that is point one. Yes, I do agree that after a stupendous listing and almost 200-300% gain in share price over the past 3 to 4 months, this quarterly result does leave a sour taste in the mouth. But probably investors might take a bit a longer term view on Adani Wilmar than just the near term, short term headwinds in terms of the Q4 earnings. That said, one company which continues to leave a bitter taste in the mouth is Hero MotoCorp. Well, dismal set of earnings for the March quarter. The performance was very weak almost on all fronts. The stock probably today is going to open lower. We'll see cuts on the stock because the margins as well as their sales had missed estimates of the street by a very long margin. And the company in its conference call indicated that they are hopeful of demand picking up going forward. But I am not that hopeful whether that will lead to the stock picking up from the doldrums that it currently finds itself in.
Overall, I think this picture for two-wheeler stocks in general remains a little bleak, given that rural demand is still to pick up in a big way. Although now the market is talking about normal monsoons and that increasing rural income, but I think right now, for the moment though, outlook on two-wheeler stocks continues to remain a bit weak. Tata Steel reported its fourth quarter earnings. The numbers were largely in line with market expectations, but according to MC Pro, what's hurting the company is that the increase in its input costs is far higher than the realizations that Tata Steel is able to make, despite the fact that it's an integrated player. It's fully integrated as far as iron ore is concerned and partially integrated as far as coking coal is concerned. Now, one good thing for Tata Steel is that its European business continues to do well. So while in the domestic market the prices could remain range bound, it still has the option of exporting to other developing countries, and there is a lower threat of China dumping steel, because there's given the fact that there is lockdowns in China at the moment, and also because of its decarbonization policy, it's been going slow on steel production.
That's all good and well said, Santo. But I think for Tata Steel now the story probably has moved beyond how much price increases they can take and how much sort of realizations they can get. It's very likely that prices will stay elevated for the near term. They may not see hikes probably to the extent that we have seen over the past 2 years because of a very a tight steel market globally. But I don't think we'll see much of a cuts that probably a lot of people might be fearing in the street. That said, the story now moves on to volumes, right? So far we have seen in the past 2 years volumes have been okay-ish. We'll not say that they've been spectacular because the economy has been recovering. Export was doing well, and now there's a concern there because China is going through a slowdown. But the domestic economy is where probably the focus will shift, whether we'll see volume growth coming in with probably the revival of the capex cycle, with government infrastructure spending going higher and higher every year. There's a story. The story probably will now be on the volume side, and that is why capex on Tata Steel's part will probably become a big thing, because the company has done well, as you would know, for the past 2 years to reduce debt on its book, and now it probably is the time to utilize that flexibility on the balance sheet to now boost investments going ahead.
But I think on the debt part, again, analysts are a little worried because now it's recently bought Neelachal Ispat Limited and it's got huge capex plans there. So debt reduction was there on the table till some months back, but this acquisition has changed it. But I think the near-term story probably for CJ and Friends could be the 10-for-1 stock split that the company has announced.
That said, one stock where there is probably will not be any worries would be Deepak Nitrite. The company is going to come out with its Q4 numbers later today, and it is likely to be very strong ahead of its earnings as well. We have seen that in the past few sessions as well. The stock has been outperforming the market a little bit. If you look at even at the technical indicators, the near-term momentum remains quite bullish, and analysts are also very confident that that momentum will sustain in the near term. Earnings, in terms of earnings, analysts are expecting about a 28% year-on-year growth in sales. But the only disappointment could be that the margins are likely to shrink on a year-on-year basis, because the company has seen input cost inflation. Input costs have been rising because of the rise in crude oil prices over the past 3 to 4 months. So that is going to affect the margin of the company a little bit. So that would be the only disappointment in terms of earnings.
Now, a couple of things have been weighing down on Deepak Nitrite for the last few months. It's never gone past its October peak, despite this Deepak Nitrite being one of the leading players in this segment. And I guess there is some bit of concern also. Company is planning to raise 2,000 crores through a QIP, which means that equity dilution. And don't forget, at 10 times book value, Deepak Nitrite is still the most expensive stock. Now, that makes sense, when it's a very bullish market, but in a market like this where constantly investors are questioning valuations, I think Deepak Nitrite could be a bit of a, more of a longer term bet than something that you would look in the short term. Coming to the next stock, Aarti Industries. Now, this is a stock which has fallen about 23% from its January highs. It's been the biggest underperformer in the chemical space. But according to Money Control Pro, it still has a lot of strength. One is that it's a strong beneficiary of the China Plus and import substitution themes. It's got a very strong end user market. Demand has been strong across the end user market, because of which it has been able to pass on a lot of the higher input costs onto its customers. And also there's a huge capex underway right now, which should start yielding results in a couple of years' time.
Yeah, but I think the focus for Aarti Industries will probably be on the margins. Margins, as I mentioned for Deepak Nitrite as well, specialty chemical and more importantly commodity chemical companies are seeing margin pressure. That will be something to watch out for. One stock that I'll watch out for is Star Health. The company's Q4 earnings were robust. They were resilient in terms of showing improvement in profitability and claims ratio, and the guidance of 24 to 26% growth in written premiums is probably going to delight investors on the last. That is one stock to watch out for. I think the markets have opened. Santo and We have a very positive start on Nifty.
But not a very upbeat start either. Nifty Bank is strong though, 123
Absolutely.
points up, 0.4%. Nifty is up about 40 points at
Well,
this
guess
stage.
what is outperforming?
What is outperforming?
Nifty mid-cap.
Okay.
The mid-cap stocks are back. They have regained a little bit of the outperformance that they had lost in the past 2 or 3 sessions. So yeah, good signs for retail investors.
Yes,
Santo.
I guess all the Robin Hoods are back. HDFC Bank, the other stock now, it's fallen very sharply from the highs it had touched on news of the merger of HDFC into the bank, but there's been some bit of buying interest over the last few days and stock has been inching up. There's good bargain buying around 1300 levels as it can be seen from the price movement. Also, this is the bank which has delivered one of the best, rate in terms of loan growth. It's among the top banks out there, and besides that, it's also a fact that the return on assets has been quite good. Overall, there is a overhang because of the merger news. However, that said, it still makes a good bet for the long term.
Sandro, talking about best, Godrej Properties, okay? What a Q4 performance. The earnings print in terms of sales, in terms of bookings, in terms of average realization, they were on, above street estimates across the board. They have returned to profit in the March quarter after reporting a loss in the year ago quarter. They have reported a profit of about 352 crores in the March quarter. Importantly, what really catched my eye is that Q4 sales bookings were up about 17%. But if you go through, some of the, the internals of the earnings, the volume or in terms of the areas per square feet that they have sold has not really changed that much. It has grown about 1%. But the increase in sales booking is generally indicating that there's some return of pricing power for Godrej Properties. Of course, Godrej Properties caters largely to the premium segment, and therefore, given its quality tag and its market leadership in that segment, it is now exhibiting a lot of pricing power. So that really bodes well for Godrej Properties going ahead.
Well, some bit of money, the profits made in the stock market is being diverted to real estate. That's what people are saying, which is one of the factors driving real estate demand at this point in time. But the moment market stalls, then probably you could see some bit of demand easing there. And don't forget, interest rates are rising.
I don't know how you can pick holes in Godrej Properties, but that said, another stock where I don't think you will be able to pick holes is Ramkrishna Forgings. Stellar Q4 earnings, and it is going to be probably a trigger for fresh buying in the stock going ahead. Net profits soared 143% year on year, Santo, and operating profit were up by 52% on a year on year basis. Now, this is all well and good, right? But my thing is that what really caught my eye is that about a year ago, 2 years ago, Ramkrishna Forgings had just started getting into the EV space. Supplying auto components to EV manufacturers, and already this year they have now seen a 2% contribution from EV space into their sales, and the management is guiding that this contribution could rise as much as 6% by FY24 itself. So that begs the question whether Ramkrishna Forgings could become a proxy for investors who are looking to make money out of the entire transition to the electric vehicle space in the coming years and decades. So that is one stock to really watch out from, not only from the short term perspective but from the long term perspective.
Well, before we move on to the last stock on our radar, a quick look at the market. I think Nifty has given up most of its gain and is just about flat at this point in time. So,
but some very interesting stocks. Bombay Burma Trading is doing very well, up about 5% in the session. JSW Energy strong, although the earnings were a bit weak if you take out some of the one-offs, but their stock is still up about 4% in the session. Dhani Services and Ajanta Pharma are up about 2% each, and Tata Elxsi is doing about 1.5% on the uptick.
Well, among the prominent losers, Hindalco is down by a little over 2%, and you're seeing some bit of selling pressure in Adani Green as well. That stock is down by about 1% odd. So, Bajaj Finance, the last stock on our radar. Well, the stock has been under pressure ever since its blowout Q4 earnings, which shows, yeah, the earnings were blowout, but it once again puts the focus on the same thing, valuation. How much are you willing to pay for that? And this is something I've been saying again and again. At about 7 times, its book value, at price to book value, clearly Bajaj Finance is the most expensive stock in the NBFC space. And while the management has said that it has no plans to convert itself into a bank, Bajaj Finance valuations are high even compared to its historical averages when it was growing at about 35 to 40%. Now the growth has moderated to about 20 to 25%. So probably you could see the stock underperforming for some more time.
That said, Santo, valuations are expensive because the company consistently keeps on delivering on growth and earnings. No matter how much skepticism is there. You remember there was a time in 2020 when people were expecting Bajaj Finance to go into triple digits, 900 levels, but the stock bounced back, and the management also, it seems, is bouncing back with the stock. Last year they indicated, they laid out their digital transformation plan, and now for Bajaj Finance the valuations is not just only an NBFC valuation, but it also is a fintech valuation as well. Given its size, given its know-how, when a company like Bajaj Finance is entering the fintech space with its the ecosystem app that they have launched, or other plans that they have on the digital side, it begs the question that, of course, why not pay the premium for a consistent growth compounder over the years.
Short point, CJ, like green and other things, fintech is also a nice fancy term. See, at the end of the day, it's an NBFC, it lends money, it has to recover that money. So all that thing you say about fintech, maybe it will increase the reach, but then it needs to grow its book. Well,
Genius is always doubted, Santo.
Yes.
Genius is always doubted in the beginning.
Well, that said, it's time for a quick check on the market before we let you get back to your trading terminals.
I think we are in the red now. I think both Sensex and Nifty are flat. They're just mildly in the red. We are probably flat on the market at this point of time, but the mid cap and small cap space is outperforming at this point of time, and I hope that sustains.
I hope you enjoyed watching this session of Markets with Santo and CJ.
Yeah, and we'll let you get back to your trading, and we'll catch you live again at 3 p.m. with the entire day's action. And also, please post your feedback on the comment section below and follow us on the social media links at the bottom of your screen. We'll see you soon. Thank you.